Welcome to our channel, where we provide valuable insights and expert advice on finance and economics to help you become rich. Bear markets occur when the stock market experiences a significant downturn, often characterized by a decrease in stock prices of 20% or more. During a bear market, investors may feel tempted to panic and sell off their stocks. Instead, investors should take a long-term perspective and remain cautious during a bear market. This means staying diversified, avoiding risky investments, and sticking to a disciplined investment strategy. It's also important to remember that bear markets are a normal part of the stock market cycle, and they eventually come to an end. By staying cautious and disciplined, investors can weather the storm and come out on the other side, ready to take advantage of the next bull market. Understanding market trends and how to identify a bear market. So what we mean by a market trend? A market trend is the general direction in which the market is moving. This can be up, down, or sideways. So how can you identify a bear market? One way is to look at the performance of the overall market, as measured by indices like the S&P 500. If the index is consistently falling over a period of time, it could be a sign of a bear market. Another way to identify a bear market is to look at market sentiment. If investors are feeling pessimistic and are less willing to take on risk, it could be a sign of a bear market. Once you've identified a bear market, what can you do? One strategy is to reduce your exposure to the market by selling off some of your investments. This can help you avoid potential losses if the market continues to fall. Developing a bear market investment strategy. First and foremost, it's important to understand that in a bear market, it's not always best to sell off all of your stocks. While it may be tempting to get out of the market altogether, this can actually be a costly mistake. Instead, consider diversifying your portfolio to include investments that are less vulnerable to market fluctuations, such as bonds or real estate. It's also a good idea to take a long-term view when it comes to your investments. While it's natural psychology of human being to minimize your losses in the short term, but it's important to remember that the stock market has a history of bouncing back after a downturn. By holding onto your investments for the long time, you can potentially ride out the bear market and come out ahead in the end. Additionally, consider taking advantage of low prices to buy into companies that you believe are well-positioned for the future. In a bear market, many solid companies may be trading at a discounted price, providing an opportunity to buy in at a lower cost. Just be sure to do your research and only invest in companies that you believe have a strong potential for growth. Finally, it's crucial to keep a close eye on your investments and regularly review your portfolio to ensure that it aligns with your goals and risk tolerance. By staying informed and making strategic decisions, you can navigate the bear market and come out on the other side in a strong position. Diversifying your portfolio to minimize risk in a bear market. As investors, it's important to always be thinking about ways to minimize risk in our portfolios. One way to do this is by diversifying our investments. Diversifying simply means spreading your money out across different types of investments, rather than putting all of your eggs in one basket. This can help to protect your portfolio from volatility and reduce the overall risk of your investments. In a bear market, where the overall market is declining, it's even more important to diversify. This is because a bear market can affect different types of investments in different ways. For example, while stocks declining, bonds may be holding steady or even increasing in value. By having a mix of stocks and bonds in your portfolio, you can potentially minimize your losses and protect your wealth. So how do you diversify your portfolio? One way is to invest in a mix of different asset classes, such as stocks, bonds, real estate, and commodities. Each of these asset classes has its own unique risks and rewards, and by investing in a mix of them, you can potentially reduce the overall risk of your portfolio. Another way to diversify is by investing in different sectors within each asset class. For example, if you're investing in stocks, you can spread your money across different industries, such as technology, healthcare, and finance. This can help to protect you from any specific industry downturns and reduce the overall risk of your investments. Finding opportunities in bear markets through value investing. Value investing is an investment strategy that focuses on buying undervalued stocks with the potential for long-term growth. In a bear market, many stocks may become undervalued as investors sell off their holdings in fear of further declines. This can present opportunities for value investors to buy these stocks at a discount and potentially profit from these stocks. So how can we identify potential opportunities in a bear market? One approach is to seek out companies with strong financials and underlying business fundamentals, such as a good balance sheet, steady revenue growth, and a solid competitive edge in their industry. These companies may be able to survive the downturn and come out even stronger afterwards. Another way to find opportunities is to look for companies that are being unfairly punished by the market. This could be due to short-term setbacks or market overreactions that don't accurately reflect the company's long-term potential. By identifying these companies and buying their undervalued stocks, you may be able to profit from their eventual rebound. Protecting your investments with stop-loss orders and hedging techniques. First, let's talk about stop-loss orders. A stop-loss order is a type of trade order that automatically sells a security when it reaches a certain price. This can be helpful in protecting your investments because it allows you to set a threshold for how much you are willing to lose on a particular security. For example, let's say you bought shares of ABC Company for $100 a share, and you set a stop-loss order at $90. If the price of ABC falls to $90 or lower, your stop-loss order will automatically sell the shares, limiting your potential loss to $10 per share. Now let's talk about hedging techniques. Hedging is the process of reducing the risk of potential losses in your portfolio by making investments that offset the risks of other investments. One example of a hedging technique is diversification. This involves spreading your investments across a variety of different asset classes, such as stocks, bonds, and cash, to reduce the impact of any one investment on your overall portfolio. For example, let's say you have a portfolio heavily invested in tech stocks. To hedge this risk, you may want to consider also investing in more stable asset classes, such as bonds or real estate, to provide balance to your portfolio. It's important to carefully consider these strategies as part of your overall investment plan. The role of cash reserves in a bear market. One strategy that can be helpful in a bear market is to hold a portion of your portfolio in cash reserves. Cash reserves are funds that are readily available to be used in the event of an emergency or opportunity. Holding cash reserves can be beneficial in a bear market because it allows you to take advantage of potential buying opportunities when prices are low. For example, let's say you have a cash reserve of $50,000 and the market takes a downturn. If you see a stock that you believe is undervalued, you can use your cash reserves to buy the stock at a lower price, potentially realizing a profit when the market recovers. It's important to note that cash reserves should not be your only investment strategy in a bear market. Diversification and long-term planning are also important considerations. However, having a cash reserve can give you flexibility and allow you to take advantage of potential buying opportunities. Staying disciplined and avoiding emotional decisions during a bear market. One key to navigating a bear market is to stay disciplined and avoid making emotional decisions. Here are some tips for doing this. Number 1. Have a plan. Before the bear market begins, it's important to have a clear investment plan in place. This should include your long-term goals, risk tolerance, and a strategy for how to allocate your assets. Having a plan can help you stay focused and avoid making impulsive decisions based on emotions. Number 2. Don't try to time the market. It's impossible to predict exactly when the bear market will end, so trying to time the market is usually a useless effort. Instead, focus on your long-term plan and try to ride out the downturn. Number 3. Avoid making extreme changes to your portfolio. While it may be tempting to sell all of your stocks and move to cash during a bear market, this can be a costly mistake. Instead, try to stay the course and make any necessary adjustments to your portfolio in a measured way. For example, let's say you have a well-diversified portfolio that includes a mix of stocks, bonds, and cash. During a bear market, you may want to consider rebalancing your portfolio to maintain your desired asset allocation. However, selling all of your stocks and moving to cash could leave you missing out on potential recovery when the market eventually turns around. Thank you for watching, and be sure to subscribe and check out our other videos for more insights on economics and finances.